We all know Brian Moynihan as the chairman and CEO of Bank of America, but he also chairs the International Business Council for the World Economic Forum. And working with other major companies and investors, he's put together something investors and companies have been looking for, and that is a uniform way of measuring a company's performance on environmental, social, and justice issues. We now welcome Brian back to Bloomberg to take us through what he's come up with. So, Brian, thank you for being here. Give us a sense of what you did come up with. You've got a fairly rigorous schema here for reporting.
Well, thank you, David, for having us here. So the International Business Council is a global organization consisting of 100+ companies, about a third of which are in Asia, about half in the United States, the other third in Europe. And they've been working for the last couple of years to define, how to implement the Sustainable Development Goals of the UN. And you need a set of metrics to measure that so people can genuinely test whether it's investors, whether it's society, civil society, or other companies that can generally judge whether they're making progress. So we set about with a group of us working on it, the IBC, and got the big four accounting firms involved and Klaus Schwab leading the World Economic Forum. And they came up with 21 core metrics, 20-some core metrics around people, prosperity, principles of governance, and planet that basically follow the SDGs in terms of outline and give measurable standards that consolidate a lot of other standards out there, but give measurable standards that people can hold themselves and disclose and be accountable for, which is something we've needed.
So anyone can go look at these, and I encourage people to do it because they're pretty straightforward. As you say, they're very specific. There are numbers attached to them. Do these apply across sectors? Because different companies may have different relationships to some of these issues.
Yeah, I think they will apply by sector. So the IBC is a group of companies which represents all kinds of companies. But in the World Economic Forum construct, there are what they call industry verticals, i.e. the oil and gas companies, the auto companies, the financial services companies. So we try to build a set of metrics which go across any kind of company around the core issues around implementing the SDGs. And the SDGs, the world adopted in 2015, 197 countries adopted them. And then the IBC membership said we will run our companies to help drive the SDG implementation in 2017, and now you have a way to measure whether we're doing that. But you have to back up for the full thing to go to basically what these metrics measure is stakeholder capitalism. The idea of you've got to do a great job for your customers, your employees, your shareholders, and society. And that's the basic tenet here that Klaus Schwab and the World Economic Forum have been working on for 50 years. The BRT last year, it's a way to measure stakeholder capitalism.
So what kind of buy-in are you getting? You said that a large number of companies helped put it together. Are any of them actually pledging to use these and report against them? Are any of them reporting against them already?
Yeah, well, some people report against parts of them already, and they may be in different fashions. Like we have a human capital report, which would include many of the measures around the people side of it. We have the climate disclosure that we do, which may meet the climate disclosure, but it's different pieces. And so many of the companies do it in part, and that was the wisdom that Klaus had and the group had to get the big four accounting firms, because they went and looked at all the measurements out there, pushed them in a pile, and think of them as concentric circles, whether it's the Climate Disclosure Project, whether it's SASB, or whether it's GRI. And they looked at all those, and they said, where's the common circle? So many companies disclose part. The goal is between now and early January to get many more companies to sign up and then basically roll through and start disclosure in the next year.
Brian, as a practical matter, I don't think the private sector can do this by itself. And it is global. It is the World Economic Forum, after all, whose auspices you're operating under. What kind of buy-in do you need from governments all around the world?
Well, the team has been working with not only governments, i.e. the Bank of England, when Mark Carney was there, it had a major role in working and has as a special envoy has that. We've been working with Mark in his various capacities. We've been working with the EU. But it's also these standard setters, the rating agencies, and then all those standard setters I mentioned before. And the idea is we've worked with them all and coalesced them all and said, this is a convergence project. It's not a we're better, we're smarter, we've got a better idea. It's you've had all these ideas. We just have to organize them. For the company's perspective, what's in it for a CEO like myself is if I agree to do this once and I do it in a way my accounting team's colleagues can say it makes sense and is audible and measurable, then when everybody comes other people come and say, I'd like you to do something different, I can say, no, this is the way we do it. It's recognized, it's measurable, it's comparable across companies. So if you want to measure me against one of my competitors in terms of what we do under Scope 1, Scope 2, and how we're working on Scope 3 emissions or something like that, you have it all on paper. So what I can do is have a much more organized framework. So it takes all those elements to make it work.
You deal with the U.S. government fairly regularly, I dare say. What kind of reaction are you getting out of this administration? Because there have been some things they've done that have expressed at least skepticism about considering ESG in investment decisions.
There have been some back and forth with the rules and regulations, but let's go back to 2 or 3 principles we're trying to establish here. One is the world believes we have to make progress on these major issues. That's what all the countries signed on to in 2015 with the SDGs. That takes $6 trillion a year. The charity in the world is about $1 trillion a year. It's wonderful. It just doesn't enough money. The governments of the world think about the operating budgets being a negative basis just because of the dealing with the COVID crisis and other issues. The money's not going to be there. The private sector and aligning capitalism, making capitalism work to achieve these goals is the key to actually having the money to get them done. And so that really takes 2 people, operators like ourselves, and then the owners, which are the investors. And the investors are coming at the same thing. So whether government is for moving it faster or slower at a given time, the reality is the investors, the people who own the assets, the people who own stock in our company, and people who invest with Merrill Lynch, for example, want their companies to both do great for them as shareholders and do great for society. So this is being driven really supra any government or any nonprofit or any guidepost. It's now being driven by the people that own the companies.
Brian, one of the 4 categories, as you list them, is people. And right up at the top of that category, and what you've put out, is diversity and inclusion. Talk to us a little bit about that. Specifically at Bank of America, you have a new lead outside director.
Yeah, we've had the pleasure of having a lead outside independent director named Jack Bovender for the last 5 or so 6 years. Jack retires with the annual meeting next year. And so the board elected Lionel Knoll to succeed him. Lionel is been with us for 5 or 6 years as a director, at least, maybe a little longer. Does a superb job for us. But he is an African American, and it'll be the second time our company has actually had a board leader as an African American. Walter Massey was the chair for about a year and a half early in the decade.
I dare say there's been an issue, actually, particularly in the financial services industry, about whether there's a sufficient talent pool, I think was the term used by one of your competitors. What is your experience at Bank of America in terms of having a diverse talent pool you can draw upon in order to bring people in from outside at all levels of the company?
Well, we look at our company. There's 8 levels in the company that my colleagues run for me and the board of directors. And we measure diversity representation at every level, and we measure it against the standards of society, especially in the United States, where you can do this a little more easily. And so we look at the male-female representation, which is more than 50% women, and then we look at it at every level. And all we're striving to do is to match the percentage in society is 17% Hispanic, 13% Black, African American, Native American, Indian, Asian Indian populations. We're looking at all those to try to figure out how do we get to match at every level. In some places we have more work to do. Some places we're in good shape, and it really depends on the business and the heritage of it. As we bring people into the company, the 2,000 plus kids we hire out of school every year, it just completed another class. They are completely diverse, and as you move through the organization, you have plenty of diversity to rely on, and all we've got to do is be careful how we promote and pay attention, and we've made great progress. We've increased the representation of managers dramatically over the last few years, both of women and African Americans and Hispanics and others, but we have more work to do in some areas, and we just have to do it. There's plenty of talent in the company and plenty of talent outside, and we acquire it all the time.
When we talk about personnel at the financial institutions, particularly the big banks right now, we think about diversity and inclusion. We also think about the overall level of employment. We've had some significant layoffs now announced by a couple of your rivals, most recently Goldman Sachs. You early on in the pandemic said you were going to not lay off anybody through the calendar year. Do you anticipate significant layoffs at Bank of America in the future?
We manage headcount very carefully. So when I took over as CEO, we had 305,000 people working for us, and today we have 212,000 or round numbers. We measure it very carefully. So we'll keep letting attrition be our friend, as we say, and we'll keep working the headcount into what we need. Right now, we're temporarily staffed a little higher because, frankly, for the safety of the teammates who are high risk relative to the COVID virus, we had to get them out of the public domain and move them, and then it took us a while to reapply them to other tasks. And in their place, we had to hire new people to replace them. And so we'll work it back down, and we've said no layoffs for this year, and we will stick by that.
Brian, you have such a unique vantage point into the U.S. economy, particularly when it comes to consumers, all sizes of companies, small, medium, and large. What are you seeing in terms of spending patterns right now, particularly as we see some of the stimulus that had happened earlier in the year wear off?
Well, David, you and I talked a week or so ago, and I said that the consumer spending would continue to be strong, and it does. And today you saw more confirmation in the outside world of that. What we see is year-to-date, the 2020 spending, which is about $2.2 trillion through the 27th of September by Bank of America customers, is basically a little bit up from last year. So just think about that. With all we've gone through in society, with unemployment rising, with the disturbances, with people staying at home, and all the back and forth, year-to-date, 20 is the same size as 19. Now, admittedly, it moves around a little bit of what it's spent on, and admittedly, it had an interesting path. At the beginning of the year, January and February, you were up 9% or 10% cumulatively through the first 2 months. Then you dropped down. Then you actually fell to -3%, -4%, and then you worked your way back up to flat cumulatively, and that's been good. So September's bigger than last year. Year-to-date, we're up a little bit, and the idea is to keep pushing that along. In the end of the day, in a consumer-driven economy that the United States is, if the consumers are spending, that will mean the economy will slowly work through and get back in shape, and the unemployment will come down because people spend money, and that creates jobs.
As we went into the pandemic, it was the shutdown in the economy to a large degree. There were a lot of loans that were deferred, whether they're mortgages or business loans, things like that. As you look at those deferrals, do you think some of those are going to turn into delinquencies?
As you look at our deferrals at the high point, we were about $50+ billion. We're down to about $14 billion. $11 billion of those are in the mortgage arena just because of the nature, the length of deferrals. Our credit card deferrals are down to next to none. $400 million in total deferral. It's not going to be an issue. The people paid. We went to our customers and said, if you need a break, tell us, and they did. And we went up to 2 million deferrals. We did 480,000 in a week at one point. We're down to a couple thousand a week, and it's really a non-event. The real estate piece, the consumer real estate piece, home mortgages will work through based on the statutes and rules that were passed. But the consumer's in good shape and paying us, and our delinquencies are good.
Consumers are in good shape. We still have a lot of people unemployed that were employed before the pandemic. We're working it down. We're adding jobs, but not as fast as we were. We have something like 11 million people unemployed. What does the U.S. economy need from your vantage point right now to get really fully back?
Well, the economy, the thing about the economy that people have to focus on is you had a deep trough in the second quarter, and you're having a big restoration. Recovery might be too strong a word, to bring you back to an economy which is about 95% of the size that it was before the crisis. And now we have to close that 5% up and grow through it. The good news is that our economists basically moved in our last estimates up a little bit more in the near term and moved the break-even point where the economy post-COVID is as big as the economy pre-COVID into the first part of 22 from the end of 22. That's good news because that means we're coming out the other side. So what do we need? From a human aspect, we need to make sure that we take care of the people who are affected by this virus who because of the virus can't get back to work. And that's a lot about the restaurants, a lot about the industries that were talked about before I came on today in terms of airlines and cruise ships and then help the states get through this fiscal hole, put in the nonprofits, the performing venue type sectors, performing arts sector, the nonprofits, the great nonprofits in New York are sitting that provide these great performance venues for us. We have to, in my mind, we ought to have a stimulus aimed at helping them. And because in the end of the day, they haven't crossed the river yet. There are a lot of industries which are back to normal sales levels and doing fine that we ought to take the careful resources that we need to usher on behalf of the American taxpayer and aim it at the places where it's going to have the most benefits. So that's unemployment support for those unemployed and a support for those companies to continue to be able to be there on the other side of the crisis.
Give us a little sensitivity analysis on the relationship between getting that fiscal stimulus out of Washington and your projections on when the economy comes back.
Well, I think right now the assumption is that the economy is kind of to the level, so it would move it out. I'd have to ask the experts again what they think the difference is. They don't bake in a lot of fiscal stimulus right now because if you think about it, when they came out with the last assumptions, there's not as much baked in just because of the politics at the time. It's encouraging to hear that they're talking. I think hopefully we'll hear something positive here in the relative future, but it's not so dependent on it now, but it would be much faster recovery, and it's the right human thing to do.